Hey everyone, and welcome back to the Your Money Your Life podcast, episode 203 of the podcast. Make sure wherever you're listening, you like, subscribe, 5-star rate, and review this podcast before we even get into what we're going to get into this week. Also, do you like the new merch? The new merchandise purchased by my fiance. I enjoy it. I love it. If you like it, let me know in the comments. Like, subscribe, 5-star rate, and review the podcast. Maybe you'll get one of these Nike made sweatshirts, New Street Advisors groups. We'll be able to send them out your way. Before we get into it this week, let's jump right into the market update of the week. Always a favorite time for people to talk about what's been going on in the market. And we'll even look back at the year. This is the QQQ, so a heavily tech index that year to date is up 55%. People don't remember this though, right? Like when a stock drops, it has to go up more than it dropped to even get back to break even. So, right, like so it doesn't. If it drops 20%. If it goes back up 20%, that's not break even. You're still lower than when you started. So that's something that people who don't mathematically actually understand. But anyways, the market of the past month or so has been having a pretty decent ride. We've talked about it for the main part: CPI lowering, the Fed saying they might start cutting rates in 2024. But we believe they're going to keep rates high for at least now. They can't move them until unemployment goes up or into we see a crash in the housing more of a slowdown in the housing market, I would say. But in general, it's been a decent ride this past week for the market. And let's take a closer look at what is exactly happening. We're seeing earnings. Micron jumped 7% after some strong quarterly results were announced. And again, I talked about Micron on CNBC this past week or this Tuesday, I believe. And so Treasury yields are continuing to fall. So those yields are falling from the height that we saw a couple months ago. And yeah, it's really just been at a surge kind of in the last couple of months. That we're seeing here. And that might be, pullback might be necessary at some point because, of course, just straight up is never good for the market. And those might see people take profits, a pullback, and that's okay. That's usually actually a healthy sign in any bull market run. You're seeing different stocks move. And again, it's basically on the fact that the Fed is definitely done raising rates and they just might keep rates steady for the foreseeable future. And from there, we might see rate cuts sometime in 2024, depending on what we see going on in the economy going forward. So again, a strong year for 2023 as a recovery from the bear market of 2022. And we'll talk more about the review of last year versus what's happening this year, and what's going to happen in 2024 and 2025. Let's jump into current events. I saw this one. Childcare now takes two jobs. So it's actually increasingly more expensive to take care of children. Monthly childcare payments have surged 32% above the pre-pandemic average, um, hitting 56 per year in San Francisco. Families are getting resourceful now. They're saving money by staggering their work schedules, meaning working at different schedules so they don't have to use childcare as much. Um, and others are upping their income via side hustles and Uber and Lyft driving, and growing group is even working for their childcare provider in order to reap a discount. Interesting. Um, High earners are taking a hit. A one parent in a pretty comfortable income bracket of 400,000 per year. That family skipping big vacations in order of making childcare payments. So um, people are realizing that the childcare payments have increased as everything has increased because of inflation over the past couple of years. Like even childcare payments now, it said a parent who had a unique solution to skyrocketing childcare costs for her three children. She's like, I work part-time at the daycare they attend for a 3,500 a month discount. She has three kids and she works part-time at the daycare now to get a discount um on her childcare costs. So it's incredibly more expensive to take care of kids. And people are trying to use, new fresh ways to make those payments because again, it's weighing heavily on folks, those childcare costs. In more corporate finance news, Citigroup, we talked about their Project Bora Bora. They're doing a restructuring to their whole business, and they just announced they're nixing or cutting their distressed debt trading business. So They're streamlining its portfolio of business, and CEO Jane Fraser, she's trying to hit performance goals. And the last casualty, the latest casualty, it's global distressed debt. It used to be a high performing group. It has about 40 people on the team that got nixed. They announced they're shuttering the one time industry leading municipal trading business. It's going to affect another 100 employees. So it's small in Citigroup's 240K employee base. And a lot of them are hybrid, are said to be on the edge of potential layoffs. So that's just it's news when they're doing restructuring, because again, they've announced this big project Bora. They're going to restructure the whole business, and it's news because they're doing that, but it's not a huge amount in the grand scheme of things for them. I think more is coming down the pipeline for Citi, and more cuts as they restructure their existing business portfolio to boost returns and to be more profitable. And the executives are looking to trim and pare back some of these expenses, which is, of course, is labor expense. So that's going to be coming down the pipeline. We'll be praying for those folks. In merger news, Paramount and Warner are opening deal talks. So two of the biggest names in media and entertainment, Paramount, Warner Bros. They met Tuesday for preliminary discussions on a possible deal. So this would bring together two huge brands. So Paramount Pictures, Warner Bros. Studios, that's CBS, CNN, and HBO, paving the way for potential powerhouses across Hollywood news and streaming. This comes after people are saying that Paramount has amounts of debt. It's a debt-ridden company. They're looking at possible sale of BT. So they were trying to sell BT. That didn't work out. They tried to make Tyler Perry pay $3 billion or something of that nature, and he wanted to only pay $2 billion. And so they couldn't trick Tyler Perry into buying BT for the valuation that they thought it was worth, where he didn't seem to think it was worth that much. So Paramount seems to be trying to really streamline, diversify their business to get a deal done, because they're ridden with debt and they have some assets, but they think there's a dislocation in the marketplace of what they think the assets is worth versus what the market thinks it's worth. So they're looking at options. They're looking at options hard, and I think that's a big move because they have a lot of content assets that will affect the average streamer watcher of anything. So that's going to be really, really important to watch. This is a story that I saw this week that I thought we should talk about. So Bird, if you guys remember this company, again, we talked about 2021, the craziness that it was. And one of the companies that was caught up in the hoop, the craziness, was Bird. This is a company that was a scooter company that IPO'd during that time in 2021, and they were valued at $2.5 billion by investors. I never bought Bird, the stock, and I didn't know much about it. I'd never seen a Bird in New York. I've seen other like scooters. I maybe seen a Bird once when I traveled. I didn't know much about it, but they were valued at 2.5 billion, and they just filed Chapter 11. They're trading on the open market, and someone said the rough market price or market cap was like $2 million. So imagine that a about $2.5 billion valuation in 2 years goes to a couple million. They filed for bankruptcy. They were touted as environmentally friendly alternative to driving. Um, it was big during the lockdown, but the market cap, now they're saying that the market cap was unable to keep its market cap above 15 million for 30 consecutive days. So they got delisted because the New York Stock Exchange has different requirements for companies to be on there, and they're not meeting those requirements because you have to keep your market cap at least above 50 million for 30 consecutive days. And so investors pull their money out. People that invested at the top of this Bird, let's even look at this chart. I'm actually curious if it's still trading. I don't even know what their ticker symbol is. Is Bird still trading? For the YouTube folks, we are looking at the stock chart of Bird for the podcast listeners. I think they took it off trading. Yeah. But as you can see, the all time doesn't look good. You can't even get, trading at $20. I'm sure plenty of people out there that were listening to Reddit for listening to freaking everyone just buy this, buy that. They bought into this Bird company and took a huge, huge loss. Hopefully not with a lot of their capital. But that's what happens a lot of these times is people just have euphoria, and that euphoria and that craziness will certainly come back when people are looking for gambling or looking for a quick fix. That will always come back. And we'll talk more about that in our other roundtable, which was discussing a 2023 review and looking into 2024. And of course, you see it here in more news. Bird got delisted, shares plunged 97%. Some cities from Paris to Philly have banned e-scooters as accidents soar. Okay, so that's another interesting tidbit that I didn't know. They banned e-scooters in a lot of cities. I'm not against e-scooters. I actually think they're cool. I don't have one, but there's nothing wrong with them. I do believe you need to be safe and stuff. I was actually reading on Twitter. They said that motorcycles are incredibly dangerous. You got to be safe with these things. Even if you're a nerd, like it looks nerdy and corny, you got to wear a helmet because these things are dangerous. You're out in the open roads and it's just you, it's your body, like versus a huge mechanic machine that is a car, truck, van, any of those things that could really, really injure someone. It's funny how as we get older, we're super, super cautious. You definitely get more conservative as you get older with your body, with risking injury. Definitely, no, you just don't want to do that. Um, so that's eBird. That was an interesting story that I think thought we should look at. Um, More stories that I think were interesting, and we'll get to those. Sales of virtual headsets, reality headsets slide as consumers steer clear of the metaverse. So these augmented headsets that were popular in 2021, um, they're shipping crazy. Now these shipping sales have dropped nearly 40% this year after they only dropped 2% last year. Um, that's a kind of crazy drop down. Searches for metaverse have plunged 96% since its 2021 highs. Again, everyone again was couple things rich in 2021 and they were bored in 2021. They were just and stuck home in 2021. So there was different things, the trends. Some of them were gone, some of them will recover, some of them will come back. But we've talked about a few of them. But this is an interesting thing that people are like, all right, we're back outside for the foreseeable future. No longer want a headset that takes me to this virtual metaverse, even though again, I think some of these trends will recover. If you think of people being more on screens versus outside, people getting into sports gambling, different things and trends that I believe in long term, but we'll talk about those again when we get into that section. As far as other news, there was a big deal that got scrapped. Adobe was going to buy Figma. So Adobe, the Photoshop maker, they were scrapping its deal to take over a web-based design platform called Figma. This is again, this deal I think it was announced in 2021 or 2022. Huge dude, 20 billion, overvalued. The antitrust um, regulators came in and they scrutinized the deal because they said it was a little bit knocking off two of the biggest competitors in the marketplace and bad for consumers. So Figma holds a larger share of the market for collaborative design software than Adobe's XD, and regulators didn't love the idea of combining the company buying up its competition. So um, they had to scrap the deal. And that was a $20 billion merger that was going to be done, but they had to scrap this deal. So that's something to look out for. You look at these big mergers that regulators coming in and saying, nope. Last year, a record 58% of households own stocks. So that's interesting. So let's talk a little bit more about 2023 in review. I have to go back to my notes and see. We might do a review. I know this is our second to last podcast before the end of the year. We might have to go back and look at what I said in the review podcast for 2022 that was upcoming for 2023. But I'm fairly certain what we did talk about was that there'll be a recovery in the market, which again, we've seen um, unemployment rise. I don't know if we talked about that, but unemployment has risen a little bit, slightly, not crazy. The recession people are talking about still a couple of months out, few months out, I would say a couple quarters out, where they'll actually announce it. I think it starts in Q1 of 2024. And there's some other things that have popped up as well that we talked about, but overall themes that we like have actually came to fruition. We did see a really, really strong market recovery, um, and other things that were kind of a theme that we saw after the harshness that was 2022, which wasn't a fun time for a lot of people. Personally, I don't know what personal goals you had out there. I think for myself, they were really, really on target. And continuing. I think the one thing I want to do is push harder at the last half of the year. I think things went so well in the beginning of the year. I just could have pushed even more further at the last half of the year, which is what we're going to do in 2024. We're kicking it up a notch. If you're not, you know, working to the ability that you want, you could definitely kick that up. I'm certainly going to do that. working harder than you want, working, doing all the things you want to do, especially personally, professionally, all those different things. You definitely have to want to do that. As far as the themes for 2024, I mean, if you think about it on the economic level, there will be, a spike in unemployment at some point, and at that point, they're probably going to print money, meaning the Fed government printing money to make assets go back up after assets go down for a little bit. Um, you know, I think there'll be a temporary drawback in the market when they see unemployment spike and the Fed has to cut rates and print money, but then that'll recover. Um, I think we'll have a decent year in the market, maybe not the craziness of the rebound that we had this year. I think we'll have another decent year. You'll definitely see some of the growth assets, the crypto, all these different things start to go up again as people start to gamble and do those things that they did, and then people click buy again. You'll see that on crypto side, on the east side, we're still heavily involved. Again, I still hold those positions and believe in those positions long term. Um, and I think that's you'll see that even further down the pipeline as well. So I think in general, we're doing a little bit of review. I want to do another one next week in our roundtable, but I think that we're seeing a lot of things that we forecasted. But again, a lot of people are gonna, get caught up in things that are outside the realm. That's really not what we do here. But in general, I think those things will shake through. But folks, this is another fun episode. Make sure you like, subscribe, 5-star rate and review, comment on the merch, the Nike New Street collaboration. And we'll see you again next week.